This is Richard Dennis. He started trading at 17 years old with $400 in his personal trading account as a runner on the trading floor at the Mid-America Commodity Exchange. And over the next 18 years, he turned that $400 into a whopping $200 million. While he's widely known as one of the most successful traders of all time, his trading strategy was eerily simple. And he believed that trading was a skill that could be taught to anyone. As a matter of fact, his trading strategy was so simple that he went on to teach a random group of 14 people with no prior trading experience his simple trend following strategy that I'm about to lay out for you in this video, and they went on to make a combined over $100 million. In this video, I'm going to break down his amazing story and his simple trend following trading strategy that's still applicable today in many markets, which I'm going to include his entry criteria, his exit criteria, and his position sizing that made him an absolute fortune. So just for some context, the early story of Richard Dennis, like I mentioned, he started on a trading floor when he was 17 years old, and he actually borrowed $1,600. He had nothing to his name. He borrowed $1,600, and he used $1,200 of that $1,600 to sit at the Mid-America Commodity Exchange, and then the remaining $400 he used for his personal trading account. So he used that $400 to start trading, and by the age of 26, he was already a millionaire. And as he rose up as a successful trader, he eventually meets his now business partner, a guy named William Eckert. And William Eckert was a mathematician that had a background in math and in philosophy. And the two had this serious disagreement. Richard Dennis believed that experience was not necessary and anyone could be taught to become a successful trader. And Eckert believed that traders were born and that they had to have some unique ability. So they ran this really famous experiment where they basically placed this ad in this newspaper looking for random people that would be interested in becoming traders. They were going to get a 2-week training from Richard Dennis, learning his trading system. And then he was actually going to fund each one of these traders with $1 million. Richard Dennis and William Eckert were going to take 85% of the profits, and the trader was going to be able to keep 15% of the profits, kind of like how a prop firm works today. So when they put out that ad in the newspaper, hundreds of people applied, and he selected a small group of 14 people that he named his turtle traders. And he coined them the turtle traders because of a turtle farm that they had seen in Singapore. And he was amazed how quickly and efficiently turtles grew. And Richard Dennis wanted to do the exact same thing, but with traders. Now, just to give you an idea of how this experiment went with these 14 traders, you can see this newspaper article that basically says winning commodity traders may be made, not born. And essentially, these were each one of the 14 traders that he had hired. And this is their average annual compounded return. If you look at the average amongst this group of 14 traders, it was 80%, which is absolutely insane considering these are random people with no trading experience. And they beat the S&P index, which is really hard to do, which averaged 19.2% during that same time period. And so Richard's hypothesis of whether trading could actually be taught or not was resounding yes. He said in the newspaper, trading was teachable beyond his wildest dreams, meaning that anybody could figure this out. So now that you know how impressive the track record of this experiment actually was, let's go ahead and let's dive in and take a look at the actual trading strategy. How does it actually work? And is it actually applicable in today's market? So first things first is we'll look at their position sizing. And the turtles used a concept known as N, which N was used to represent the volatility in the market. And all they were doing was basically using the ATR, or the average true range, to measure the volatility over the course of the last 20 days. And the idea behind their position sizing was to risk between 1% and 2% of their equity on each trade. So if we just pull up this gold chart here, for example, come on over to indicators, and then you type in ATR, you can see the average true range, which will pop up right here. And then you can go ahead and you can change this to 20. And then this is essentially how they were determining N. So if you look at here, N is currently 30. So let's just go ahead and use a really simple example using a $10,000 account, and you want to risk 1% of the account. That means that your max dollar risk per trade would be $100. Now, let's go ahead and assume that the volatility measure, again, that ATR over the past 20 days, let's just say, for example, that that is $2. And let's say we want to use 2N as a stop loss. So how would we do that? Well, we would calculate the $2, which is the ATR, times 2, which would give us 4. And then we would take $100 and we would divide it by 4, and that would give us 25 shares. So that's the amount of shares that we'd want to trade on this particular trade. So bottom line, they're risking 1% of the account, 2% maximum, and they're using N, or the average true range of the past 20 days. Okay, so far position sizing is pretty simple. Now let's go ahead and let's take a look at how they would actually enter. Now, there are actually 2 different entry criteria for 2 different systems that they would trade for, System 1 and System 2. System 1 was essentially a 20-day breakout, and System 2 was a 50-day breakout. And essentially what they would do is they'd trade with this indicator known as Donchian channels. In order to put it on here, you can go ahead and just type this in TradingView, and then boom, it'll pop it on there. And you can see that I have it on the 20, which would be essentially the breakout for system number 1. And essentially all they would do is they would wait for the candlestick to hit this upper band, and when it would hit the upper band, they would enter the trade. And this was basically signaling to them that there's a potential trend. Again, this is a trend following strategy. And they actually didn't even wait for the candle to close. They would actually just enter as soon as it hit. So really, really simple. And entry criteria for system 2 was basically just looking at this on a slower time frame. So looking at it on the 50 period, and they would do the exact same thing. When it would hit this upper band, like you can see right here, this is when they would enter a trade. Now, one other important thing that they would do is if the trend does start to move in their direction, then for every 0.5% that they gained, they would actually pyramid, and they would add another 0.5% after they've made an extra 0.5%, and they'd move their stop loss up also a 0.5%. And the reason that they did this was to continue to add on to winning trends. And this was really a trend following system that they were trying to catch these really big trends in the market. Now, the last thing that I want to share with you is their exit criteria. But before I show you the exit criteria, there's really 2 big problems that face traders today. Number 1 is that they don't have a proven trading edge. And number 2 is they don't have enough capital to actually trade with. And we've actually solved both of these problems, and we guarantee that we can help you get funded $100,000 with trading capital with a prop firm using our AI trading system that we call prop farming, or you literally don't pay us a penny. And this has now worked for over 700 traders that we've helped become funded prop firm traders without ever having to take a single manual trade. So if you want to see the full demo of how our AI trading system actually works, then go on over to www.propfarming.com. Now, the exit criteria was also really, really simple with this trading strategy. System 1 had an exit criteria of the 10-day low. So you basically look at the past 10 candles. If it closed below the low of the past 10 candles, then you would exit the trade. And for system 2, it was also very simple. It would just be a slower period. So you'd look at the past 20 days, and if the candle closed below the 20-day low, or the lowest candle in the past 20 days, then you would exit the trade. And the whole goal of this trading system was to be in this trend until the trend was invalidated, which they used with the 10 and 20-day lows. So to conclude, the secret really was that trading could be taught to anybody as long as you had a proven edge and traded it mechanically like a robot, much like how trading bots can flawlessly execute predefined edges today. So if you're looking to become a more mechanical trader like the turtle traders, or an algorithmic trader even, then you may want to watch this video right here about how one trader in our community turned $500 into $100,000 in 7 months using this mechanical trading robot. Go ahead and check out that video right here.